It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
You may know that the old stretch IRA rules for inherited retirement accounts have been replaced with new 10-year rules. However, did you know that you may only have 5 years in certain inheritance situations? We'll address that issue for a fan of the show as well as other listener questions on today's episode of the Wise Money Show.
The 5-year rule. We're not talking about Roth IRAs, although that's an important 5-year rule. There's a few of them that you need to know about, but we're talking about the inherited IRA 5-year rule, and my guess is you've never heard of it, and so we're going to help you avoid it. If you have a question for the program, it's just questions today. You can call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us. Leave questions there as well, and then all over social media, wherever you're at, we are there as well. Search The Wise Money Show. Seems super harmless. We have a retirement plans team when we are helping small businesses set up retirement plans and create that opportunity for their employees to build wealth. And it's very common for our team as they're sitting down with an individual who needs to open their 401k. All right, let's get it open. And how do you want to contribute, pre-tax or Roth? Going through those 5 key decisions. And the 5th decision is, all right, well, who's your beneficiary? It's very easy and tempting to just say, I don't know. I'll come back to that. Let's leave it blank. And thinking, yeah, I'll get back to that, of course. And you never do. And ultimately, you think you're invincible. Nothing bad will ever happen. The sun's always shining. And then time passes and you never updated this thing. Mm-hmm. It's very, very possible where you either think, all right, I'm not married yet. So, my sister drives me crazy. So I'm just going to leave it to my brother, or I'll leave it to mom and dad or whatever. And then you kind of get frozen. You just don't list a beneficiary. That can be very problematic.
It happens all the time when people are in a hurry to get some actions taken within their financial life. And, you get started on a process. I mean, we see this all the time with estate planning in general, right? You spend all this time and effort and money working with an attorney to get documents drafted, but then you don't fully implement it. Yep. You don't circle back to it. You have good intentions, and there's no deadline. There's maybe no one in your life who's prompting you to circle back to these things and get the details right. So maybe today's show can serve that function for you.
Yeah, and I don't think, why do people make that mistake? Is it because they're in a hurry? No, it's because they're lacking confidence. And I don't want to make a mistake. And so what do you do if you're really good at procrastinating? You procrastinate. And you say, hey, I got to make the right decision. I don't know what the right decision is. I'm not going to do it. Estate planning, you're talking about that, Josh. What do? I'm not going to do my estate plan because I don't know who's going to get our kids.
Yeah.
And so this is the tough thing. And we would always encourage someone, look, put it in. It's the rough draft. It might not be the right answer, but you will someday fix it.
Yeah.
And if you don't, one of my favorite Ed Slott stories. Ed Slott is a tax guru. A guy had a 403B. And he named his sister as the beneficiary. Mike, you reminded me of this.
Yeah.
So he named his sister as the beneficiary. Then he got married and lived happily ever after, and then he died. And his wife said, sweet, there's $1 million 403B that's coming to me. And they looked, and the beneficiary was his sister. And his wife said, well, that was supposed to come to me. And his sister said, well, guess what? Looks like it was supposed to come to me.
Yeah.
And his wife said, well, I guess I'll sue you, which she did, and she lost. So you have to be very, very, very careful. We're in soccer season. This is an own goal, right? Mm-hmm. To not name a beneficiary. Now, if you don't, there are rules, and every custodial plan or every agreement has a default beneficiary if there's no beneficiary on file.
This is the home run off of Jose Canseco's head. Like the outfielder's head. You guys remember that? It happened earlier this year to someone else as well, where their outfielders going to the warning track, fly ball. they're reaching, they're going to rob the home run, and the ball just doinks them right off the head and then goes over the fence. Just awful. So yes, you don't want to do that. You don't want to make that blunder in your financial life. So, okay, we're leading right into that with a question from fan of the show.
Dude, I want you to just say own goal. Just say
Own goal? Okay.
Yeah, there you go.
All right, that's as far as I'll go.
No, okay, it sounds better than
football.
Doink off the head.
All right, so what about, so wise money guys, what about an inherited Roth with no designated beneficiary? What is the drawdown strategy of that? I thought it would have been 10 years, but my attorney thinks that because my dad's Roth did not have a beneficiary listed, that the drawdown or RMDs is only 5 years. What say you? Oh, my goodness. Well, we've got to talk about RMDs with Roths, but let's just hit it like right off the bat. Designated beneficiary, not designated, not listed. What's the rule?
Wait, who's asking the question?
It's an individual.
Okay.
Someone.
Okay.
Someone. Yeah.
So, okay. So,
nameless.
Yeah. So nameless individual. Here's what. Yeah, I got good news and bad news. I don't know what you want first. Let's go with the good news. The good news is with the Roth IRA that I inherit, I can take the money out and it's not taxable to me because Dad already paid the taxes. That's the good news. The bad news is instead of pre-2020 where I could take the money out of this account over my lifetime, I now have 5 years.
And you might say, wait a second, I thought it was 10, right? That's the question here. So prior to 1/1 of 2020, the rule was you were allowed to stretch an inherited IRA. Meaning, when you inherited an IRA from someone that wasn't your spouse, you could take it all out right away. Or you could just take a little bit out and have that investment account continue to grow tax sheltered for your financial future. Well, how much do I need to take out? Well, there was a required minimum distribution even for Roth IRAs that you inherited. But there was never a time limit. You could just take that minimum amount out or more every single year and continue to let the account grow. Well, that changed with the Secure Act 1.0 for anyone who dies after 1/1 of 2020. Now there are 3 categories of beneficiaries. That's what this new law created. 3 categories. And I'm going to go in reverse order here, but I'll use the jargon, forgive me. But first, you've got non-eligible designated beneficiaries. So designated meaning listed as a beneficiary, but not eligible for an exception. So therefore, this category, and this is going to be the biggest category, 10-year rule. You've got to withdraw. You inherit that IRA from dad, and you've got to withdraw the entire account. You got to empty it within 10 years. If that individual, the original owner, had already passed the required beginning date, meaning they were taking RMDs, then you'll have to take RMDs as well over that 10-year time period, but the account needs to be emptied in 10 years. That's non-eligible designated beneficiary. Next category is eligible designated beneficiary. So designated meaning listed beneficiary. Again, not this instance, but eligible. Eligible for what? Eligible for an exception to that 10-year rule.
Yeah, this is the category you want to be in.
Yeah, right.
It's people like your spouse, maybe if you have a minor child, a disabled beneficiary, someone who's chronically ill as the beneficiary, then they are given an exception to the 10-year rule, and it allows them to potentially still stretch this out over their lifetime. It's, in other words, the old rules that we loved so much can still apply for these individuals.
And with some exceptions, like they might have delay. And so, but there's eligible, there's special treatment. And so, but the third category, this is the category you do not want to be in, and that is a non-designated beneficiary. So no beneficiary listed. And guess what? In that situation, and that is the situation that our question asker finds himself in, 5-year rule. You've got to withdraw the account within 5 years. So there's no required minimum distribution, no RMD. This is a Roth, right? So there's no RMD. That's good news. The bad news is you can't let that thing continue to cook and build and grow tax-free for 10 years. You've got to withdraw it in 5.
Yeah, and that could make a big difference. When something is growing tax-free, you want to let that thing simmer in the crock pot as long as possible. And to be cut in half, to go from 10 years down to 5, that could be meaningful.
Now, there's one other exception within this non-designated beneficiary, and that is something unique called the ghost rule. the ghost life expectancy rule. This does not apply to the ghost life expectancy rule because their individual is not past the required beginning date, because there is no required beginning date with a Roth IRA. For those of you inheriting a non-designated beneficiary or account for someone that it's an IRA and they're past their required beginning date, you might want to be aware of the ghost life expectancy rule. We're not going to get into that, but you're going to want to work with your CFP. Okay, how do you avoid this? What are some other planning opportunities with it? That more coming up here on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time every Saturday morning, also on podcast at the same time, and also on this this YouTube station as well, 10 a.m. every single Saturday. If this is too long for you or you're wanting some shorter form content, we've got that for you as well. 8, 10, 12-minute long next wise step videos, as well as shorts, all designed to help you take your next wise step in your financial life. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. And if you like the content, we appreciate it. Leave your inheritance questions as well below. We'll answer them for you. So, okay, so this ghost life expectancy rule, you can actually still stretch.
Is it a mini stretch?
No, it's a stretch. But you are risking it. So you're past your required beginning date, and then you delete your beneficiaries. And then it's going to go through the will. And you got to hope that it goes to the right people. And you've got probate and you've got some other issues. But then technically you could ghost rule that thing if they don't change the ghost rule. So, all right, I'm going to pick it back up. We found the name. Yep. Cara Marie.
That's a pretty name.
Yeah. So it was on YouTube, and it was a handle that was a business name. So yeah,
that's cool.
Thank you, Kara, for the question. It's a good one. All right,
that's a great question.
Let's pick it back up because we can talk about, well, how do you avoid this? And then what's the normal rhythm? And so we'll just have some banter with this. I doubt we'll get into the next question in this segment, but maybe we will. We'll see. So second segment, here we go. So there's 3 categories of beneficiaries for retirement accounts, and you don't want to be in the non-designated beneficiary. That gives you the least flexibility. So how do you stay on top of that? How do you make sure you avoid that 5-year rule? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Guggry. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Answering a question from, it turns out, is Cara Marie. Fantastic question, and she left it on the YouTube channel. And so the question was, well, how does it work for inheriting a Roth IRA from my dad where no beneficiary was listed? So how do you inherit something where no beneficiary is listed? It's going to default go through the estate, okay? And the estate is considered a non-designated beneficiary. So no 10-year rule. It's a 5-year rule. And there's no required minimum distribution every year, but you have 5 years to withdraw those dollars, and not very flexible. It would have been better, and there's no way to undo it, and you can't be mad or whatever, but it would have been better to have you listed as the beneficiary. And so I think how do you avoid this worry and this frustration in the future is have a regular rhythm to reviewing your beneficiaries and making those, making sure they're updated.
And I might expand on that and say you want to be reviewing your primary beneficiaries and contingent beneficiaries, because what if Kara, maybe her mom had been listed and mom and dad have since passed away, and there was no contingent beneficiary. She would have been the logical person to inherit this, but because she was not named at the time of that second death, nothing's listed, no one's listed, so it defaults to the estate. And as we've been saying, the estate is falling in that third tier that you don't want to be a part of. It's not eligible for any kind of stretch rules, whether it's 10 years or longer. You only have 5 years. And that can be a bigger deal when we're not talking about Roth IRAs,
Yes.
right? Because if this was a traditional IRA or some other pre-tax account, now you only have 5 years to get the money out of the account. You're stuffing more income into each calendar year over that 5 years. Could be throwing you into higher tax brackets. Maybe if you're in retirement, it's triggering IRMA for you. All types of things that maybe could have been avoidable if you just had the full 10 years available to you. And as Kara was kind of knowing, like she recognized that that was an option for me.
Yeah.
But her attorney was pointing out to her, well, it was only an option if you were named as the beneficiary on the account, either primary or contingent there.
Yeah, it's something standing out to me here. We shared the rules prior to 1/1 of 2020. I don't know, guys, on a scale of easy, medium, hard, where would you plot those rules?
The old rules?
The old rules.
I don't know. I thought it was pretty easy. Yeah.
Okay, now these new rules.
You have
where
to
would you plot
maintain it for a long period of time,
Yeah.
right? I mean, this is something that you're back in the old days, you'd have to take a distribution every single year. It's a calculation that has to be done, and you're hanging on to that retirement account probably for your full lifetime.
Yeah.
As opposed to the new rules where you still have some flexibility. It's all got to be out in 10 years, but there is a certain amount that you may have to be pulling every single year, and then the full balance out by the end. Still a lot of moving parts there.
So
but
where
at
would you
least
plot
you're
it?
only signing up for 10 years of juggling.
Easy, medium, or hard?
Medium.
Oh, my goodness. The 3 categories of beneficiaries. And then subcategories beneath that. This is hard. This is extreme hard.
Yeah. Well, here's the
You're sounding very whiny right now.
No,
Ultra, super, mega, supreme hard.
I mean, in a vacuum, if this is all you ever do, this is easy.
Yeah.
This piece of cake. This is not that complicated. If this is not what you do for a living and you're not terribly interested, this is terrible.
Yeah.
It
against one,
drives
Josh.
the importance.
Stinking up the house.
It drives the importance of doing multi-year tax planning for sure. Because where you're placing this income, if you've got 10 years to get money out of a retirement account and all of those dollars are taxable, you want to choose wisely how you're pulling the money out. This question from our listener, Kara, is about a Roth IRA. So tax planning isn't the issue there. It's just how long can we take advantage of the tax-free tax shelter that the Roth is providing her.
Okay, so before we get to the next question, what's the right rhythm? How frequently should you review your beneficiaries? We call that a beneficiary audit because we're great at naming things. Actually, Josh hasn't gotten a hold of that one. Josh will.
Yes, I did.
Oh, yeah? Okay.
He
Well, I
probably
like
came up with that name.
beneficiary audit. So how frequently should you do that? And then how frequently should you review your estate plan? What's the right rhythm, guys?
I mean, if you, so as we work with clients, it's at least every other year where we're doing a beneficiary audit and looking at, well, who are the beneficiaries on your various accounts, and does this still make sense? And if you're looking at your estate plan, if you've got a good estate plan in place and not a lot has changed or is changing, I'd say somewhere in the 3 to 5 year range. And it's amazing how people can go 20 years. Mm-hmm. Either 20 years knowing that I should have an estate plan and I still haven't put one in place, or 20 years of, hey, I had that and we used to have kids, and the people that were going to get my kids aren't alive anymore, and my kids are all adults, and go on down the line. It just needs a nice cleanup and really to make sure, because this is I've worked with attorneys who have said, hey, we're going to set up the revocable living trust. It'll be a see-through trust. You can name the trust as the beneficiary of the IRA. That makes me so nervous. Mm.
Yeah.
And I am a trusting guy, but I don't trust. I trust that about as much as I trust gas station food.
Whoa.
I know. So anyway,
That's funny.
Nothing against.
So why would we have different time frames for a beneficiary audit versus a review of the documents? It has to do with ease of making adjustments. And, think about your investment accounts. You may be moving dollars around, opening new accounts, that sort of thing, on a regular basis. Who knows? As you make those changes, beneficiaries could get left off. Maybe they become inconsistent. Maybe something changes, and There are new family members added. Who knows? That can happen pretty regularly, and that's why you want to review those beneficiary designations on a regular basis, every year or two. But the actual documents, your will, your trust, your power of attorney, those things that the attorney helped you to draft, those are usually written a little bit more generically.
Yeah.
They're a little bit more robust, or they've got a longer shelf life to them quite often. Unless there's a major tax law change or new case law that suddenly makes some provision of that trust obsolete or a little sketchy, then you're probably okay to wait another 3 or 5 years or so. Yep. And it's certainly way more involved to go make a change if you do discover that something is needed. Amending those documents, it's not hard. It just involves the attorney. It involves their fees and everything. Whereas changing a beneficiary on your IRA, it's a signature on a form, no cost to you, very little hassle.
I think, reviewing the beneficiary on your 401k as well. I feel like that one can get overlooked,
sure,
and forgotten, especially if you're working with a CFP that does this on a regular basis, helps you with this beneficiary audit. They're likely, it's an extra step to log into the 401k and just confirm that it's set up, but follow that extra step. Estate plan, guys. What are some of the common documents when we use the phrase estate plan? What does that mean?
Well, you want to have a will, a healthcare power of attorney, a financial power of attorney, durable power of attorney. There are a lot of different names for these things, and then a living will. And what they do is, my will says, where do individually owned assets without a named beneficiary go? So what would that individually owned asset without a named beneficiary be? Could be my house if I'm single. It could be a retirement plan, which is what we've been talking about. It could be a car. It could be all kinds of different things. Yep. So that's going to go through my will unless I've made a different provision for it. So that goes through my will. My healthcare power of attorney, that says who can make medical decisions on my behalf in the event that I'm unable to. Yep. And then the financial power of attorney says who can make financial decisions on my behalf in the event I'm not able to, whether I'm out of the country, whether I'm in the hospital, whether I'm fill in the blank. And the living will says take extraordinary measures or take no extraordinary measures if I'm not expected to live.
Yeah. Mm-hmm. Yep, that's right. That's the basic estate plan, those 4 documents. And then there's a question of whether you need a revocable living trust as well. And then there's a lot more complicated estate plan structure as well. And you're going to want to work with your CFP on that. All right, we've got more questions coming up here on the Wise Money Show with Korhorn Financial Group. Kevin, you mentioned a couple weeks ago, you might have forgotten, you had a great question from someone. I don't know if you remember that or if you wanted to tuck that in. I've got the next question teed up, but I don't have the one after that.
I did have a great question.
You remember it?
No. I do.
Do you remember us talking about it?
Yes. I remember that great question. Does that count? We could talk about you could talk about like the concept of a great question. Do you think that
do you think great questions really exist? Or are they really dumb and they sound great?
There are no such thing as dumb questions, Josh. Just dumb people asking questions.
Oh. Guilty.
That is not nice. Okay, so Mikey B?
Yes.
I think we're going to have to go with yours.
Well, we've got the next question pulled up. I've got...
Well, let's do that.
I'm going to
do that up.
Okay. Okay.
I'm not getting it to pull up for me.
Sometimes you have to restart it. I got a question here about the mechanics of a mega backdoor Roth, so we can hit that one. And then, Kevin, maybe you'll think of your question by the time we get to the 4th segment.
Okay. Well, from here on out, if I ever say that, we have to capture it.
Oh, my goodness. That is how I am with when it's
no,
content.
I know,
it doesn't matter if I'm...
Well, I'm surprised
driving.
Lindsay didn't catch that.
I have an idea for a video. I have to just record it.
That was an obvious catch for Lindsay.
Way to go.
We're gonna have to bring that up in her review.
All right, here we go. 3rd segment.
So the question we're going into, which one?
No, it's a surprise. I'm not gonna tell you.
Oh, sweet.
Here we go.
Can't wait.
Here we go.
It's my favorite.
All right. What's the right strategy, the approach to save up for short-term financial goals? Is there one tried and true method, or is it just, you just wing it or whatever? What's the right approach? We got that question right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate it. Hitting questions from fans of the show. This one was texted in. I appreciate that. 574-222-2000. 574-222-2000 is how you can text in a question. Wise Money Gurus! ! Appreciate that. And my wife and I are almost done fully funding our emergency fund with another ! I am excited for you as well. That is huge.
Big milestone.
That is, and it is boring. And it feels like wasted money and all that, but it is that financial piece, that security blanket that I'm prepared for the curveball, the unexpected expense.
Man, it's not like you get to celebrate that one with anybody either, right?
Although we tell, go out and take yourself to dinner, go to Taco Bell.
Yeah, whatever.
Yeah,
do something to commemorate the milestone, but it's not one of those visible goals like you bought your first house.
Yeah.
Or
you can't even
paid
brag
cash
about
for
it.
a car.
You can't brag about it. You can't, celebrate. And don't go to Taco Bell. I don't know if there's real food there. It tastes good. All right. But now, how do we transition to saving for a home? First-time home buyers, we're renting currently. Thank you. Fantastic question.
I love this
right?
question.
And can I also just celebrate, since again, you can't really celebrate. Can I celebrate the order that you did this in? You guys are renting. You're building your financial foundation, and you said priority is filling up that emergency fund.
Mm-hmm.
Fantastic.
And you're viewing the emergency fund as separate and distinct from the down payment on the house.
Yeah.
Right? You don't want to run into the temptation of, well, let's speed along the house purchase by just committing our full emergency fund to down payment.
Yep.
Because, we can always borrow it back out with a home equity line or something like that. I mean, that can be done, but a better plan. It clearly, you've gotten this far with some great discipline. You obviously are living within your means, and hopefully you're renting a place that is modest and able to create margin in your financial life. Mm-hmm. Here's how I would approach this. If you're renting today and you want to be into a house that you own and you're going to have a mortgage, I would start building a new budget for the new world that you're going into. Build the budget as if you own the house today. What would your mortgage payment need to be? What new utility costs and real estate and maybe there's new insurance premiums that you're going to be paying. You need to be budgeting something for the upkeep. Maybe there's some home improvement projects that you want to start squirreling away some money for every single month. Whatever it is, the housing situation that you're moving towards is going to be more expensive than renting, most likely. Yep. Maybe not, depending on how expensive that rent is. But let's pretend it is for now. If that's the case, what if you start the dress rehearsal right now? You start experiencing that level of cash flow right now by setting aside these amounts, these extra expenses into a new fund that you're going to have as your down payment. You begin building it in a safe, predictable account like a money market fund where you're earning a little bit of interest, but at least it's not fluctuating in value. And that could be the initial start of cash flow flowing right into this down payment fund right out of the gate. If you can get more aggressive than that, then taking other goal achievement dollars on top of it.
Yeah, the dollars you use to build up that emergency fund.
That's right.
Yeah.
If there was other debt that could be eliminated in the short term to free up even more cash flow, all of these things help you to build cash pretty rapidly.
I was working with a realtor this morning, actually, and talking about this because we live right on the border of Indiana and Michigan. So if I'm going to do this, the human brain is great at making decisions when it can compare. And so if I have nothing to compare my situation to, in a vacuum, anything can make sense. Hey, I'm renting, I should be owning. How many people do I need to talk to who say, oh, dude, you're just throwing away money? Well, guess what? If I throw away a little bit of money instead of throwing away a lot of money, does that make me a smart guy? It just might. So to your point, Joshua, I would look at that and I would say, hey, what are the different costs associated with where I live? And I would even include how far do I live from work? And where is my house going to be? And how far will that be from work? Because the client that he's working with lives about 45 minutes into Michigan, and they work in Elkhart. So one of the comparisons that they did with what is the cost of staying where I am, and to be exact with all of this stuff. And so you look at the utilities and it's like, wow, that's a high, when you go to sell this house, it's a high utility cost. What is anyone going to want to buy that? And you're like, well, we have a hot tub. And we're taking the hot tub with us, so the next person might not have a hot tub, so take $100 a month off the utility bill. And so you can be objective about these things. So I look at what does it currently cost me, and then the cost that I would add to the bottom of that is what kind of car do I have, and what kind of gas mileage do I get, and what does it cost me? My wife and I both drive to different RV shops in Elkhart. So I need to know what are all the costs. How do the costs change if I move right to the border but stay in Michigan? And then how do the costs change if I move just into Indiana? Because in Indiana, I'm probably going to like the difference between the state income tax. I'm going to like the difference between the state property tax. I'm for sure going to like the difference between the car insurance premium that I'm paying.
Yeah.
So there are all of these things that I would want to factor in to, all right, where am I going and what are the various costs? And you might say, listen, I'm not optimizing for costs. I don't care.
Yeah.
I only want to live in Michigan. Okay, well, then that's easy. We don't have to do a lot of analysis. We'll find you a house in Michigan.
So Josh, I love that advice, and Kevin's sort of going full geek, but kind of going the same thing here is build out what would life look like and what is the cost structure of that, and start living that out. That's going to give you some resources to fund that thing. But this goes back to 3 bank account system. Josh, how many bank accounts are in your bank account number 2?
How many bank accounts?
Yeah.
I literally use 1.
What a geek.
But many people will set up a separate account
7.
for 7 is what
I
you
have
use?
7. So you
could use 10 or 20 if you wanted to.
I mean, or 21 or 22, whatever I can do to one up you.
Uh-huh.
No, so I currently have 7, not because I like a complicated financial life, but where we do our banking, we can set up an additional savings account or money market is what we're using, but you can nickname them. So I don't even know these account numbers, but when I log in, I can see the names, and our home purchase account, we retitled to home improvements. And so my home improvement account, I can see how much money is in there. Mm-hmm. We've got a car repair and replacement account. Mm-hmm. We've got, I think I might have changed it back to vacation. It was a vacation account. We didn't change the name to Disney.
Wasn't it the Disney fund?
Yeah, Disney. I think I switched it to vacation. They charge so much money, and it's not even that much.
It's a sign that you're growing up.
Thank you.
You're going to some more mature places.
Insurance and taxes, I've got that one as well. Just general delayed spending, we've got one for, I think we have 7. And so, for you, I hope you're working that 3 bank account system. And if you're saving up for a down payment on a house, that's going to take a while. Mm-hmm. I would set up that separate account. I'd call it home purchase or home something, and I'd be stuffing dollars in there.
Yeah, and if you don't do it the way Mike is describing, where you have a separate account for all of these various sinking funds or these delayed spending funds where you're saving up for some large purchase or some major expense out there in the future, then you have to have a different mechanism of organizing these dollars and designating, hey, I've got one big account. It's piling money up for a car purchase and a home purchase and a vacation and health expenses, all these different things. Well, how much of that full large account is designated for each of those items? You need probably a spreadsheet or some other system.
Yeah.
Your way is easier.
Yeah, and I knew your answer was going to be 1 because Josh is very organized. He's got that spreadsheet built, and we've used it with clients. Here's the point. I wouldn't keep it in the checking account. Right. I wouldn't keep it in the emergency fund. And one other just big compliment and kudos to you who, and we don't have your name, who texted in. Guess what you're going to want to have fully funded when you do buy that house?
The emergency fund?
Your emergency fund, right? Because as soon as you buy that house, all of a sudden you're responsible for the roof. You're responsible for that, that leaking pipe. You're responsible for critters getting into the house, getting into the basement, and trying to figure that out. You're responsible for all these extra costs. You're going to want that emergency fund. Fantastic job. All right, we've got more questions coming up from fans of the show. That and more coming up here on the Wise Money Show with Korhorn Financial Group.
That is the worst part about owning a home. Is that Dad's not taking care of it anymore. I mean, you're like, oh, we used to, the problem in the house. Yeah, this, that. No, Dad's
okay.
Dad's taking care of it now. And now it's me.
All right. So, Kevin, this is bonus content, but it is not financial related. Mm-hmm. So I told you there's all-out war on these chipmunks. And so I got these 2 traps. Mm-hmm. And one right by the garage, because that's where they were getting in. That's where they were eating all the stuff and ripping up the garage door. One right there. And then they dug underneath our deck in the back, so I had one back there. Okay, so it's just been baggage claim here. I've just been collecting these dead rodents. So yesterday, 2 days ago, the one in the back, which is less convenient for me to go clean out, had a critter back there, and I just didn't go clean it out. So I went yesterday to go do it. Trap was gone.
Got drug off by another.
So let me ask you, what do you think? Was that raccoon or something like that went and
possum
got that, or possum or whatever? Or I went around my yard and neighbor's yard. I would have thought they would have let it go because there's no way this possum or whatever was going to get that thing out. Or do you think it was a hawk and grabbed the rodent and took off with what do you think? Just your guess.
Was the rodent dead?
Oh, yeah.
Okay.
Oh, yeah. It
wasn't a live trap or something.
No,
okay.
Sadly.
I don't know.
So Cindy and I.
It's a mammal.
Lori and I.
Wolverine? What do you think? Badger?
Our favorite thing to do is sit on the patio in the back at night and watch. And you have all these birds flying overhead. I'm like, where are these guys going? And then we have a bunch of crows that live in the back. It's called a murder of crows. Mm-hmm. And they make all of this noise. And I'm like, guys, what are y'all all excited about? And then, you'll have a deer that will just walk right out in the backyard. Not any idea that we're there. And then yesterday, there was either a Cooper's hawk or a goshawk, that the little version that flew right through the low across our backyard. And so, I mean, it's cool to just sit out and see all this stuff, because it's all happening, and you're like, no, if I walk out there, there's nothing going on in the back.
Yeah.
No, if you sit still and don't talk. Oh my.
Well, that's why I asked, because so you don't live too far away from me. My guess is it was a hawk came. I don't know.
I don't know
why.
Hawks go after dead stuff.
Yeah.
Do they?
I just feel like something with 4 legs would have let go of that thing.
I don't know, like especially raccoons.
Well, just for the record, hawks don't have 4 legs. But I think
that's what I mean, because that's where what would have latched on and not let go.
Yeah, I don't know.
4 arms.
I don't know.
A beak and a mouth. All right.
So just for the record, just so you know,
that was a shot at Mike.
I was
listening. You missed it.
I was listening. I saw your lips moving anyways, but all I could think about was the raccoons that keep killing our chickens and keep dying from lead poisoning.
Yep.
Oh, dear.
Poor guys. All right. Here we go. Next question is about the mechanic. Basically, how does a mega backdoor Roth work? And then if we get through that one, that could probably take the entire segment, but I'll tee up another one. So, all right, here we go. For a segment, land on the plane. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. Go to YouTube, search the Wise Money Show. Make sure you subscribe to it there, and then turn on notifications every time we drop new content. You'll be notified, because it's more than just this 1-hour talk show that airs right there. We've got next wise step videos and shorts and different content, all designed to help you take your next wise step in your financial life. So go to YouTube, search the Wise Money Show, and subscribe to it there. Leave questions there as well. We appreciate it. We're getting into questions right now. Next one here actually comes from Spotify, and individual named there was Bay. Not sure if that's a real name or not, but here's what they asked. Okay, I'm funding my 401k and unsure about doing pre-tax or Roth 401k, but also starting to do mega backdoor Roth. How does that work if I'm contributing to my 401k? How do I actually get those mega backdoor dollars into the Roth? Question on the mechanics of the mega backdoor Roth, guys.
Into the Roth IRA is the question there.
Yep.
Okay. So just to explain, when you are contributing to a traditional or any retirement account at work, there are limits on how much you're allowed to contribute unless your employer allows you to do non-deductible or non-qualified contributions above and beyond. So there might be built into your retirement plan the ability to do some extra. And those extras have to go in on an after-tax basis. And if you think after-tax contributions, my hope would be that if you're a regular listener of this show, your mind is going to Roth. That's how you fund a Roth IRA, with after-tax contributions of some sort. In this case, it's piling up in a retirement plan at work. And the ability to periodically move money out of that retirement plan and over to a Roth IRA that you have elsewhere. The way that you do this, it's a in-service withdrawal if your plan allows it.
Yep.
There are times when if you're still working there, you may be able to pull money out of your retirement plan and move it elsewhere. If that's the case, this would be what you'd be initiating with the 401k provider. Other plans don't allow for in-service withdrawals, and the only way to be able to move money out of the plan is to have some sort of separation of service, where you don't work there anymore. In other words, you've either retired or you've left and gone to another employer. So in order to pull this off, this mega backdoor Roth contribution, you need to be looking for two provisions. One is, can I do these non-qualified contributions, these extras, and then can I do in-service withdrawals while I'm still working there?
I think I would, even without the ability to do an in-service withdrawal, if you had the cash flow and you were maxing out your pre-tax or your Roth 401k, and gosh, we don't know the details of your situation, but just the fact that you're looking at funding the mega backdoor Roth suggests that you've got high income. High income tends to suggest higher taxes. My hunch would say you're going to want to do pre-tax on your contributions, even though I'm a huge fan of the Roth. But yeah, work with your CFP, do that multi-year tax projection and plan that out. But then contributing above and beyond after tax, even if you weren't able to do in-service withdrawals and move those dollars every year or every 2 years over to the Roth so that they can grow tax-free, I think I'd still do the after-tax contribution.
Absolutely.
Yeah.
And then,
if you have the
retirement,
resources,
It'll
for
eventually benefit you,
Yeah.
for sure.
Yes.
And because then you separate from service, you switch jobs, and that's when you can then transfer. It's technically not a conversion, it's a transfer, your after-tax basis, your after-tax dollars over to your Roth IRA, and then they grow tax-free. The growth on those after-tax dollars, that's all been tax sheltered, but that's not taxable.
That's the big distinction,
Yes.
right? That's the reason why you want to make this move as soon as you can, because after it is moved over to the Roth IRA, it is growing tax-free at that point instead of tax-deferred. Big difference between the two, and you want to get as many years of tax-free growth as possible. That's why we even want to be utilizing a mega backdoor Roth contribution.
Yep.
Pretty powerful.
And if you don't have that available to you, like if you're younger right now and you're just getting started, I like if you're into planning, I like the idea of doing, because you can do pre-tax, you can do after-tax, and you can do Roth contributions to your 401k. I like, for a young person, doing some after-tax contributions, because it statistically, you're not going to stay where you are job-wise for very long. I think it's like 2 years. Like the current generation lasts about 2 years at their job. And so what does that do for me? That lets me pull money out of the plan. It separates it from the growth on that money. So I have just what I put in, but I might need that for transition assistance.
Remember all the changes they made with, was it CARES Act? I can't remember all those stimulus, where they've added this sidecar account to your 401k, where it's a side cash account that's not really in your 401k. You can pull the money back out if you need it. And then these extra provisions, if you, I mean, what are we, 5 years into this, 3-4 years into this? I don't hear anyone doing that.
No way.
I mean, and that goes back to what we were talking about with the complication of the rules before the Secure Act with inherited IRAs versus after Secure Act. Guys, they are just making a mockery of these rules, and it's ununderstandable. Ununderstandable.
Yeah, and that's a word.
Yeah. All right, here we go. Next question here comes from Tom, and this one Hertz emailed in. 5-year rule question about Roth conversions. Okay, when you got the Roth, there's several different 5-year rules. One is just the traditional, the normal 5-year rule, where in order to have the dollars, the growth on those dollars come out tax-free, you have to have had a Roth IRA for 5 years. Doesn't even need to be consecutive. Doesn't even need to be the same Roth. Just you got to have it for 5 years. But then every Roth conversion has a 5-year hold on it. So, all right. So 5-year rule question around Roth conversions. If I do a Roth conversion at age 70 here in 2026, and I first open my Roth IRA in 2026, but I pass away in 2028, will my heirs have to wait to the end of the 5-year period to pull the growth out tax and penalty free? This is tragic, and this is a common misconception. The 5-year rule, that waiting, whether it's on the normal, like the primary 5-year rule, or the Roth conversion rule, if you pass away, logically you'd think, well, my heirs will wait the rest of the time, right? No, the 5-year clock stops. That's it. If you didn't meet the 5-year rule and you were the owner, if you didn't meet the 5-year rule, there's no way that your beneficiaries, your heirs, can play catch up. It's done. So in that example, it was 2 years, not 5, and therefore your contribution or your conversion in this instance, you already paid tax on. So that basis, they don't have to pay tax on, and you astutely were aware of that. So your question was, will they have to, wait the 5 years to pull out the growth tax and penalty free? No, the growth is going to be taxable. Penalty, now, that would not apply because they're inheriting the dollars, right? So there isn't going to be a penalty that's going to be considered a qualified withdrawal, but they would have to pay tax on the growth.
That's disappointing.
It is. That's why I say. I mean, it's a heartbreaker. It's tragic. I mean, obviously tragic if you pass away here in 2 years, Tom. I hope that wouldn't happen. But yeah, this is where the initial 5-year rule. Get that out of the way. I don't know your financial situation. If you're able to contribute to a Roth, put $50 in there. Get that 5-year clock going. If not for you, then just even for your beneficiaries, right? Meet that 5-year rule. Because we were talking about mega backdoor Roth, and say you really haven't been able to fund a Roth and you're doing everything through your 401k and you do some Roth 401k, and then you retire and you roll over that Roth 401k into your Roth IRA. Does your 5-year rule for your Roth 401k, does that satisfy the 5-year rule for your Roth IRA? No, it does not. Only logically it would, but it doesn't work that way. So you roll over that Roth 401k into your Roth IRA and then you pass away. Well, if you never had that Roth IRA 5-year rule originally checked off, then your beneficiaries would have to pay tax on all of that growth, and it'd be awful. So have that awareness, plan ahead, and get that 5-year rule knocked out. So, and then on the Roth conversion, be planning ahead, being aware of those 5-year rules, having all that documentation. All right. That is all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.